Our panelists are Chee Koon, Group Chief Executive Officer, Andrew, Group Chief Operating Officer, and Paul, Group Chief Financial Officer. The session will be moderated by Mr. Wilson Ng, Executive Director, Singapore Equity Strategist, and Head of ASEAN Property Research at Morgan Stanley. Wilson, who's based in Singapore, joined Morgan Stanley in 2010 and has 16 years of experience in equities research. Let's welcome our panelists. I'll hand the time over to you, Wilson.
Hello. Thank you, Julie, for that kind introduction. Hi, everyone. I'm Wilson from Morgan Stanley. I'm the Singapore Equity Strategist and Head of ASEAN Real Estate Research. It's been a busy and exciting week for all of us, as my chairman mentioned earlier as well. A lot of events are happening, and I'm glad it looks like we'll be ending the week on a high note. What CLI's board and what CLI's management as well has been sharing with us this morning, I think has given us a lot to think about. The board was talking about supporting CLI's bid to challenge the status quo. Andrew was talking about the right to play and right to win for CLI, and Suchat, the importance of chemistry, as well as synergy. And just now for Paul, talking about the relentless capital efficiency to double earnings in 5 years, and also room to play. Oh. I'm sure, like me, a lot of you will have a lot of questions for Chee Koon, Andrew, and Paul, which we'll get to in a bit. But what really struck me from the earlier presentations was Chee Koon's mention of transformation. We keep seeing and hearing the word transformation come up through the various panels that have come up earlier this morning. And I distinctly remember 5 to 6 years ago, soon after Chee Koon was appointed CEO, attending a get-together event at a mini golf bar at Clarke Quay. I'm sure some of you were there with me at the event as well. That was a very different venue from what we were used to. And I'm not sure if you remember this, Chee Koon, but one thing that I did remember from your speech that day was that you said, if you don't try, you don't know. And since then, you and your team have been trying a lot of new things. The transformation from developer to asset manager that you mentioned earlier really has been a multi-year journey for CLI. And even today, we are still seeing the company evolve. But I would also say that it looks like you may not be alone. If you look at the broader landscape, more and more we are seeing other property companies also trying to pivot towards asset management. So if I could maybe kick off the discussion with that, do you see an advantage to moving ahead of some of your peers in this pivot? And how do you see CLI positioned relative to the competition?
Thanks, Wilson. Well, I didn't feel like, I felt like I've been running the CapitaLand much longer than 5 years. Been running like crazy, doing so many things, and even now we're still building the business. To be very honest, if I have a choice, I think that we should have transformed to be an asset manager much earlier. Asset management as a strategy, if you ask me, is a strategy that's a lot more sustainable. You're really focusing on building capabilities, bracing, and if you build capability, you invest well, you raise money from third party, and you can actually scale your business in a much bigger way. I'm not against running a development business, but development business on the listed side is really, really challenging. To be a good developer, you need land bank. You need to have boots on the ground. You need to be super local. And from a company that originates out of Singapore, there's only so much you can do in Singapore. You've got to build capabilities in China, Vietnam, India. And before we do the restructuring, I spend 70% of my time traveling to the different markets, talking to government officials, planning authorities, how to give them approval, the construction permits. Instead of spending time growing the business, I spend a lot of time doing all those things. And it sucks up all the energy to focus on growth and building the earnings income and And that translates to growing the enterprise value for the company. And if you look at, apart from CLI, you hear a number of other players also transforming. I think everybody also sees that the value of asset management platform. I think we have been lucky that we did it in about 2021. If we had delayed the restructuring a bit later, when the war started, when interest rates start to hike, I think we have been, and the China slowdown really kicked in, I think it would have been impossible for us to have done the restructuring. So it was timely that we did it. It was just a bit unfortunate that we met with all the complexities, all the macro factors that slowed us down in terms of what we wish that we could have done. But even then, we stayed razor focused in building the capabilities. And I mean, quite confident, Asia Pac growth, we are really quite settled. We are 80% there, a bit more capabilities that we need to build. And we're actually raring to go for Asia Pac.
Thank you for sharing that, Chee Koon. I think the other thing that really struck me from this morning's presentations also is that there are a lot of targets that were being shared through the different presentations, from looking to double earnings to target exposures to various markets. Now, having these targets are definitely very useful to demonstrate how committed you are to your strategy. And I know each of you is very confident of achieving those targets. However, some things may be easier to say than to do. What assurance can you give to us and the audience to give us the confidence that you will be able to achieve those targets?
I think we have been very consistent in terms of our communication to the investors. We share the good news, we share the difficult news. I mean, we have not shied away from communicating our strategy, and including some of the challenges that we face, could be asset classes, could be markets. We don't shy away. That's point number one. And the second two is the razor focus in terms of execution. Building up the teams, changing the teams, and it's quite evident. And today we are a lot more global. All our country teams are really dominated by the local country heads who are very familiar in terms of operating, finding deals, solving problems, creating value, raising money. So that takes time to build. And it's not just about recruiting people, it's about finding people with the right value system, the culture. Because you're going to be a private funds business, you have to leave a lot of the deal sourcing, a lot of the investment decisions to the teams on the ground. There's going to be co-investment, there's going to be carry, and that's how we spend time to readjust the company. And of course, the thing I mentioned earlier, in terms of, I think the listed REITs, that part is sorted out. I think there will be growth that will come. Lodging management, we spend time turning around the business. I think Kevin and his team is raring to go. Commercial management is stable. I think we can continue to grow. And I put myself, I mentioned earlier, to drive the private funds business until we see certain level of traction. That's not going to change. And I'm personally committed to make sure that it works to grow, to invest capabilities, and to raise money. Otherwise, I think there will be no credibility that I can convey to the investors.
Thanks for that, Chee Koon. Maybe just one last thing for me before we open up to Q&A to the audience is, and I think Paul touched on this a little bit earlier, when CLI looks at trying to balance delivering capital returns with reinvesting for growth, i.e. calibrating earnings growth versus dividends versus share buybacks, what kind of balance are you looking to achieve in the next 3 to 5 years, and what would that ideal steady state scenario of that balance look like?
Thanks, Wilson. I think our priority is always growing the top line and growing our earnings. So If there are opportunities for deployment, and Suchad talked about $50 to $60 billion opportunities. I know Sanjeev apparently now has to get going over the next few months. These for us are priority. So if there are growth opportunities, that will always be the first place we will put the funding, right? All the capital available will go into that. But the nice thing about real estate is you get to plan in advance. Generally, you can see some of these at least several months out. And as we've been divesting, we're getting a fair bit of cash back. So obviously, paring down debt and holding some of it allows us a little bit more flexibility. So we do grow first, then we look at dividends and buybacks. And dividends for us, I think we've been relatively consistent in the market. Every year we've been 12 cents for the last 5 years, with the one exception being where we dropped to 9, and then we gave an additional 3 cents the year after. That's generally base run rate for us. So it's really relatively easy for us to set aside knowing that we need a certain amount for dividends. And then I think the flex for us comes from any additional special dividend distribution in species or buyback. And for that, we forecast out 12, 24 months for spending, and then we calibrate accordingly. This year, obviously, we've been one of the sort of higher leader or table when it comes to buybacks, but that is because we could see that we were getting back $5 billion worth of capital through the divestments. So I don't think for us it is a certainty that we would always have that amount, but it's really, for us, we look at the total capital, which you can kind of see, and then it is growth opportunities followed by dividends and share buybacks. So the balance will change year on year. But the idea for us is, we've always talked about improving our return on equity. The faster we can grow that top line, the faster we will improve our ROE.
Of course, we set a target, hoping to achieve about billion or so in terms of profitability, 2028. Of course, we hope to be able to do much better than that. And once you can do that, and to be honest, on the road, raising funds, I'm actually a lot more confident in terms of fundraising based on the strategies. You'll find us having to use less and less of our own capital going forward. But for some of the strategies and some of the things that we are trying to do, we still want to conserve the capital to give us that optionality so that you can build a much more resilient fee income business for the investors. That's really our focus. And once you build up the machinery, and to be honest, whether the listed funds or the private funds, you can raise third-party capital, we have all the optionality with us to aggressively return capital to shareholders. We are just not at that point in time yet because we still see significant growth opportunities where we can grow enterprise value for the investors at this point in time.
Thank you. And actually, Andrew, would you like to comment on achieving that growth and having the right to play, right to win in the different regions that was mentioned earlier? Where do you see some of the best near-term opportunities for CLI?
So when we discussed this with the board a few weeks ago, I think the phrase that I used was turning presence into performance. And I think this is a key differentiator for us. If you look around the region, we have teams in place that we have been building up over the years. What is essential for us is to ensure that our teams are ready to invest into the thematics and to the types of return strategies that investors want. The good news is, if I look back on the capital that we raised in the last year, for every dollar of capital we raised, 65% of that capital, 65 cents, were successfully raising into thematics, specific thematic strategies. So that gives us reassurance that the products we are manufacturing are a result of us listening first and foremost to what capital partners want, what they are interested in. And I think Suchad that mentioned earlier that in this day and age, what is clear is that they want choice. They want to be able to choose their countries. They want to be able to choose their strategies. And our own experience supports this, where we are successfully able to raise capital, successfully able to put products out. And then the other half of the coin is obviously, well, can you invest well? Can you deliver the returns that you're underwriting? And this is where the teams come in. So two sides of the coin, your capital raising, listening to your investors, manufacturing the right products, and then on the country and fund teams, having the ability to find those assets that allow you to underwrite with confidence. So senior country leaders, investment teams that we are hiring, most recent of these yesterday, with Angelo and Rahul joining Paul and his team here in Sydney and Melbourne, I think gives us confidence to come out and then say to our investors and stakeholders, we're going to double FUM by 2x. Without that confidence, it would be very difficult for us to come out and paint that picture. And then to answer Wilson's question to Chee Koon, how are you going to convince stakeholders that you can deliver 200 billion or the TSR that we are confident we can achieve? So it all goes back to having the right people, turning that presence into performance on the ground, and listening to our capital partners and manufacturing things that we believe they want to invest into.
Thank you for sharing that, Andrew. I think now would be a good time to open the floor to questions. And if you have a question, please raise your hand and we will get the roving mic to you.
Fastest finger.
Hi. Bevan from JP Morgan again.
Yeah, yes, we're going to vote for you. It's okay, no, sorry.
I need the clients to vote for me, not for
not
corporate.
me, yeah.
No. But if you can tell everybody vote for JP Morgan 5 stars, you can vote Wilson too, but 4.5, I think. Nothing like share price is driven by many things. One of it is profit growth, ROE delivery. I think in our recent business update briefing, earnings growth can be somewhat mixed with successful divestments. ROE could be 3 to 5%. You talk about working with capital partners. A big capital partner is all my clients who are here, and we're reading our reports later on. I mean, what is if the profit growth isn't going to be fantastic next year, ROE 3 to 5%, how do we get our investor base or partners here to buy your stock? What's the catalyst should we be looking for? Should we be more aggressive with buybacks? Because if a weak share price is very hard, it will be much harder for you to deliver your 2028 goals. Temasek can wait forever. My clients do not have the luxury of time. If they underperform, they may not be around to buy your shares. So can you help us in terms of your thought process for the next 12, 18 months? How can we help our clients here make money, outperform, drive share price higher, do more deals? Thanks.
I will make one easy statement and turn it over to Paul. Temasek will not wait forever. Okay, Paul.
Okay, so I didn't realize I'm the one answering this one. I like to believe that your clients and most of our investors are medium to long-term view on us. I agree that there is absolute movement in share price up and down in the near term, but we're all shareholders, right? And for us, we look at this as a multi-year journey. Next 12 to 18 months, absolutely. I mean, we've discussed a little bit first half results. Next 6 months, still challenging. Our exposure to China, the slower growth in certain sectors has impacted us. But you have to look at us as longer term holds than that. And it used to be, I remember when LPs, a lot of investors used to tell me that short-term hold was 2 years for public investors. Somewhere along the way, it seems to have become a 3 to 6 month hold. But I think you have to look at us on a longer term basis, precisely for that, right? Yes, it's a perfect time to buy into us now. The reason we've been doing share buybacks is we think it's a good time to buy us. And if we look ourselves forward 12, 18, 24 months, we think then you see the moves like the M&A opportunities, what lodging team is doing, where we will build up in certain sectors. We think that's where the growth will come from. And we can see the seeds of it now, but it will take time to materialize. So what I would advise your clients is to hold us for more than 3 to 6 months. Come in when the timing looks right, with the fact being that we're putting all the building blocks in place, not for a short-term gain, but to build a really sustainable long-term return.
Thanks. I mean, they captured all the good points. I don't think there are things that you have not heard before. The key to us is to really be able to drive growth. Of course, obviously, I mean, we have so many things lined up. We wish that everything could be announced before quarterly results, before Investors Day. Then we come here, it's easy to show you, we are all growth oriented. But good deals takes time to cook, especially in environment like this. It's about striking the right deal, not just, again, just to do deal because, we are not afraid of facing the investors. We just do not want to get ourselves to just pursue growth. Yes, short term, I get away with the pressure of the headline pressure, but I'm creating longer term problems for the teams or for even the future leadership. That's not what we do. I mentioned earlier, we looked at very transformational M&A, apart from many other things that we look at. It's having the courage to walk away because we know short term it's good, long term it's going to destroy value. Yeah, short term, it will be, wow, CLI is at it again. We do major transformational deal, AUM growth, we'll hit our AUM target. It's a highly easy and popular thing to do for any senior management team. But the thing is, are we doing it right for the long term? We are not afraid of growth. We are not afraid of doing big deals. I mean, as you can see, the first deal I took over in September 2018 and January 2019, announcing an 11 billion enterprise value deal, trying to buy over from Miguel, the whole company. So we are prepared to do big deals, including, the earlier deal that we said no to. It's in terms of the value itself, we are looking at almost $5 to $6 billion US. It's not about wanting to do big deals. It's about making sure we do deals so that we can answer to you, not just every quarter, not just for this quarter, but in 2 years down the road, 5 years down the road, that we are doing deals that grow the future earnings potential for the company. So I just want to rest with you. We are growth oriented. We spend more time trying to curate deals, trying to raise money, than trying to think about share buyback. Not that it's not important. It is very important. The fundamental point is that all our compensation is tied to share price performance. So share price doesn't perform, we get hit. I get hit the most. Obviously, I'd rather just buy share price and drive so that I get a good reward. But we have to look at it. What does it mean? Because we are equally invested as the investors in CLI. Yeah, so share price performance is definitely important.
Thanks very much. Very loud and clear. Share price is very important. I agree. Ascenda's been a great deal. All makes sense. This SE Global, very complimentary. Kudos to Janine. Perhaps she needs a pay rise as well. So, yeah.
Thank you. Next question, Joy.
Hi, Joy from HSBC here. Two questions. One on Andrew's slides. I think in your slides you introduced, you actually listed 3 regions for new REITs: India, C-REIT, and Japan. And Australia, sorry, actually 4. So you launched Japan through an inorganic sort of acquisition. How should we think about the other 3 regions? What's the plan for that? And then my second question on equity base. So I think in the slides we have 1 billion, more than 1 billion earnings by 2028 to 2030. Is that 1 billion corresponding to today's equity base? Or how should we think the right equity base for that 1 billion earnings? Thank you.
Why don't I take Okay, thanks, Joy. So on the REIT side, let's start with C-REITs. And I think this is something we talked about before. It's very tangential and complementary to what Tze Shyang's trying to do, right? China for China. We've started with the private side of the business, matching RMB to RMB. We are well on our way on the debt side of the business with Panda bonds, RMB loans. It's really helping that cost of Chinese capital borrowing has come down below Sing dollar borrowing. So that has really flipped around. So we can't swap it quickly enough. So what's missing is RMB equity on the public side. And that is something that I think the Chinese government understands. I think we were one of the first to go in at their invitation to have a discussion about what is it about the REIT environment that they should be paying attention to. My personal opinion is that the Chinese real estate market is arguably the second largest real estate market in the world. The Chinese government wants a stable, tangible asset that its population of savers can invest into. I can't think of a better product than a REIT. And I think it comes along at the right time for the Chinese domestic investment environment as a whole. But like we see in all REIT regimes, this is going to take some time. They're going to figure this out. The current set of rules doesn't really work. But as a product, it makes perfect sense for us and perfect sense for what Zhexiang's trying to do. So I think as soon as we believe the conditions are right, you should not be surprised to see us come out with a domestic REIT, C-REIT product. In Australia, again, the market is very established. The key decision there is obviously internal versus external models, right? So something we study very hard. As a product, it makes a lot of sense in Australia. The Australian market understands the product very well. It works well in Australia, but you still see very mixed performance. Some of the Australian REITs now are not doing well. There's a lot of market speculation about where their future lies. Given that we've just made a couple of senior hires, we are going to invest $1 billion Aussie into Australia, it would be very natural for us to look at this space as well to see what we can do. So I would say it's complementary product, but not something perhaps as tangible or as concrete as a C-REIT. And then lastly, on India, you look how the Indian REIT market is exploded in a good way. We actually think it's a bit ahead of itself. It's highly total return driven at the moment. The fee structures don't make sense. The borrowing still doesn't make sense. So all of it has to sort of flow into line before we consider it seriously. But again, if we are the leading business park, top 3 business park, top 3 logistics, top 3 data centers, and whatever else we may choose, or Sanjeev may choose to go into, you've got a emerging REIT landscape that is very interesting. You've got an InvIT ecosystem for infrastructure assets that is also emerging very interestingly. And again, it gives us an ability to look at another capital pool where you are logically want to park the assets and match that with the currency as close to home. So if I look across the countries that we are focusing on, the 3 countries that naturally pop out to us are China, India, and Australia. Different stages of thought and design into it. But if you ask me 5 years from now, would we have one REIT in each of these markets? I think that's absolutely potentially possible.
Organic, is it?
Either way. Either way.
On the question on the equity base, yes. So we are targeting to get above $1 billion in profit. Ideally, we would love to be more than that. You know, it's not a 1.0 type, 1.0 billion. So our equity base will correspondingly adjust for it. We're currently close to 14 billion equity base. If all the country teams and product heads here and all can grow us to a 1.4 billion, perfect. 1.4 billion, 14 billion equity base gives us a 10% ROE. The way the current plan works is we are assuming a reduction in capital. There is a reduction factored in there, but it's not a linear journey for us because it partly will depend on how fast the teams are able to deploy capital and grow the business. So, you know, we're going to pay our dividend. It will reduce our capital base. We'll see some potential fair value movements that will also adjust our capital base. And then, depending on the growth opportunities, we'll know how much to buy back on shares in terms of the equity. So I would say we do think it reduces from the 14 billion. In the longer run, as Chee Koon mentioned, we don't think we need as much capital. But how fast we move over the next 4 years will really depend on how effectively we can redeploy. If we can redeploy for growth, then the reduction will come slower. But eventually, we do think that it's very easy for us to drop this by 2 to 4 billion.
Yeah, emphasize again what Chee Koon said about how strategic the balance sheet is and our capital base is. And the comment was that we're actually the largest asset manager globally in terms of the capital that we have at our access to deploy, internal capital. And so when we discussed this with the board's advice to us was, listen, this is highly strategic in this day and age because the inbound inquiries we are getting are all from folks who don't have what we have. And so you can look at it in two ways. Do you want too much of a good thing, or do you want not enough of something that everybody wants? And I think we prefer to take the former now. Let's hang on to this incredibly strategic capital, and let's see what we can do with it in a situation where increasingly partners are coming to us and asking us to share in that capital and deploy capital to that. So exactly to Paul's point, let's take the next couple of years and see what we can do with this. And depending on where we get to, we can then shape the capital efficiency or solve for the capital efficiency equation by returning excess capital as we see fit and as you see fit.
Maybe I can get Kevin to share, he's too quiet, to share the journey of how Ascot, how it transformed from an asset-heavy business to an asset-light business, first giving some capital to do some acquisitions, and now the fee income is just solid. Kevin, why don't you share a little bit in terms of the journey?
Sorry, this was quite unexpected, so I'm going to go unscripted. Well, I think if you think about Ascot as a journey, it started in year 2000, and that's where we are more a owner-operator. Everything that we manage is pretty much owned by our balance sheet or one of our funds or REITs. And that mindset continued for a very long time. Until the early 2010s, I would say, that we went out to third party to say, look, we'll be happy to manage some of your assets and earn a fee out of it. And lo and behold, we actually gained quite good traction. In 2008, we only had 20,000 keys. Today, we have about close to 170,000 keys. So we grew about 8 times in the span of 15 years. But that required a long mindset journey whereby we need to stop behaving like owners. We need to start behaving like operators. And it's not an easy journey because when you're owner, whatever you do, whatever you say is right? But when you are serving a third-party owner, you really need to put yourself in their shoes, understand what they want, and make sure that your objectives are aligned. So that transformation took us a couple of years, but I'm quite glad to say that we've brought in new people, we have fresh blood, we do new things, create new brands, and that actually gained quite good traction for us. And today, the journey is not complete. We went from asset-heavy to asset-light, managing third-party properties, and we're going to move even further, from being asset-light to people-light, and that's embarking on a franchise journey whereby we don't even manage the properties by ourselves anymore. It's going to be managed by franchisees, like what we're doing with Quest in Australia. So you will see that although today, globally, if we count every single body at the property, we have maybe 16, 17,000 people, but people that are on our payroll is probably about 500 plus people. So we're going to use that 500 plus people and not increase any more headcount significantly, and continue to grow and manage even more properties through a franchise format. And that helps us move from asset-heavy, asset-light to people-light, driving ROE much higher. So I think that's probably a journey that we are going to undertake with the private fund as well, and I see a lot of similarities between the two.
Thanks for that, Kevin. We have time for just one last question. Brandon at the back.
Hi, just ask 2 questions if I have time. The first one will be with regards to ROE. I think Paul was saying that you were targeting double-digit ROE, and how should we look at it, given that one of your capital top-up is going to come from sell-down of stakes in your REITs and also your private funds, and looking at where the REITs are trading at, if you were to sell them down, it would actually be ROE dilutive, right? That's my first question. And the second question would be, if we look at the deck where you put this M&A of platforms, there's a bracket there that says largely private funds, right? But if you look at SC Capital, it came with 6 billion of listed FUM. So is it correct to say that if any platform comes into the market with a decent listed platform, it would not be appealing to you? Yeah, thanks.
So maybe let me start with the M&A component. So I would say the focus for us is growing the capabilities in areas where we are not currently as strong. So for us, that's why it's largely private funds. We are focused on building that component. I think with SC, we ended up being incredibly fortunate. There's a very strong Japan team, a very strong private funds team, and they also happen to have 6 billion worth of a listed REIT, which was a beautiful addition to us because we've been looking at the J-REIT market for some time. So I wouldn't say for us it is, we wouldn't do a deal if it had a listed REIT. I think it is more the fact that we are focusing, we've been looking for private fund platforms, areas that can help grow that capability. So we wouldn't discount the listed REIT side. On the ROE component tying to potential stake reductions in the REITs. Which is why I think the focus for us is on operating profits, operating ROE. So we don't disclose the carrying value for us for the different REIT stakes that we hold. Some are below book, some are above book. Partly it is a function of where we acquired the stakes or how it grew. So there is some variability to that. As we sell down or reduce some of these stakes, there will be some fair value gains or movements, divestment gains or losses as we do that. That will come in time. I think that one we recognize that there is never a perfect time to sell anything, right? In certain cases, we have to make a disciplined approach. So as we look at the next 4 to 5 years for the REIT stakes, we may see some movements similar to when we divest some of the assets on balance sheet. We'll see some gains, we'll see some losses. I would say that we look at that separate from our operating return on equity. So we talk about reaching $1 billion, we're just talking about the operating component. We may have some movement up and down as we divest some of these stakes.
Okay, so that's actually about all the time that we have for this session. But before we break out for lunch, Chee Koon, would you like to share some closing remarks?
No, thank you all for coming. I hope at least after today's session, the key takeaway is that we are positioning the company to grow. A lot of it will come from the private fund side. The idea is to grow from today, where we are about 110 billion in terms of funds under management, to 200. Asia Pac itself, we are more or less quite there in terms of capabilities. I personally think that with the focus now to also look at the US, Suchad is right. We potentially can go even higher than the 200 billion that we set out for ourselves. Because the US market is really big and deep. You get it right, you actually can grow very, very quickly. And the key is to make sure that we find the right deals that can really help us to generate long-term enterprise value for the group. Thank you.
All right, thank you, Chee Koon, Andrew, and Paul. Let me now hand the time back to Julie.
Thank you very much, Wilson, and thank you, Chee Koon, Andrew, and Paul.